Okay, in this video I'm going to show you how I go about selecting what options I put out on the trade alerts. Okay, here's an example of Southwest Airlines. They announced earnings and price dropped right down into a fresh demand zone. Okay, so at that point I analyze a couple things. Number one is, where is my first target going to be? Okay, so because of this gap down, we have a supply zone up here where this magenta zone is. But as you can see, price didn't break through any real previous demand, so it's not a real strong zone, but it still could hold. Okay, so I'm going to identify that as our first target. If that zone holds, then we want to get out of that trade, obviously. So that's going to be our target on this trade. Now, I also take a look at why it dropped down, okay, and what the trend of the stock was before it dropped down. As you can see, it was in an uptrend, okay, and they actually came out with positive earnings, but the stock went down anyway. Okay, so that's a good indication that, hey, it's probably going to at least get back to the point where it was before earnings came out within a reasonably short amount of time. Okay, so I'm going to probably go out, and actually this is what I did on this one. Went out about 30 days on this option. Okay, so then what I take a look at is, okay, the area that it gapped down from, the price that it gapped down from is $42.31. If this option went to expiration, what would its value be at $42.31? Okay, if I went with a $38 call, then the value at expiration is going to be 42.31 minus 38 is $4 and roughly $4.30. So we'll just round that down to $4. With a 3-to-1 reward to risk, if that option is going to be worth $4 at expiration, then I need to divide that by 4. So I can't pay more than $1 for that option. Now, if I remember right, I actually paid considerably less than $1 for that option, but we don't want to pay more than $1. If we had to pay more than $1 for that option, then we'd pass on that trade. One of the other reasons why we structure our trades where the amount invested is your risk is because the trade could go against you and then turn around and come back. How many times have you been stopped out of a trade just to have it turn around and come back and would have eventually been a winning trade? Now I'm going to show you an example of an actual trade that we took. PTC Therapeutics, I actually bought calls right in this area right here. Okay, and that was actually a demand zone at that point. Well, the next day the stock dropped down to $4. Earnings came out, and we normally don't buy options the day before earnings come out, but I did on this one because I really felt that it was going to go up, and plus the risk was really small. I only had to pay 50 cents per contract to make this trade. Okay, but the trade did go against us. Okay, using normal risk management, we would have, if we would have bought the stock or in the money calls, we would have gotten stopped out. As soon as that trade started going against us on the day of earnings, we'd have gotten out of it. What I did is I bought the $7 calls and only paid 50 cents, and as you can see, 6 days later it gapped up above the point that it gapped down to, and then continued up. At the time, we had a supply zone right in here, this area that it gapped down from. Then, as you can see, a few days later, it made it up into that zone. Actually, I believe I exited this trade on this day right here because I already had well past my 3-to-1 reward to risk. My 3-to-1 reward to risk was based on this point right here, the point that it gapped down to. So at 10:09, as you can see, I paid 50 cents for a $7 call. Okay, and that $7 call would be worth a minimum of $3.26 when it hit that line. Even $3, at $3, that's 6 times your original investment. But because it gapped up above it, I went ahead and let it run a little bit more and took even a bigger profit. I believe I got over 1,000% profit on this trade. So this is why we structure the trade so that the cost of the option is your risk. That, the amount that you're investing is your risk, and this happens a lot. Here's an example of Twitter options that were about to expire worthless. This day that it gapped up was a Friday. I had options, I believe they were $19 calls, that expired on this day. Okay, so obviously I was assuming those calls were going to expire worthless. Okay, but look what happened. The stock gapped up at the open and then ran up another dollar. I ended up getting out of that trade with a huge profit because I didn't pay very much for these options. I don't remember the exact amount, but I got out with a huge profit on an option that was about ready to expire worthless. So you never know when this can happen, and this is why we structure our trades this way. They can go against you, and this happens all the time. Or stock can go way against you, but if you have plenty of time, you have time for that stock to come back and at least get partial return on your investment. Now, also many times we can't get the 3-to-1 reward to risk, but if we feel strongly about a trade and we can't get that 3-to-1 reward to risk, and that could be for a couple of reasons. It could be because we really want to go out 2 months on this trade, and there's just too much time premium in it. There's not enough move to our target to get 3 times what we pay for the option. Or it could be because it's a high volatility stock. High volatility drives your option prices up, and so you can't get that reward to risk based on the time frame of the trade. Many times, if the stock moves to that target, within a week of making the trade, then you can get that 3-to-1 reward to risk, but you don't know that that's going to happen. So what I'll do in a case like that is I'll put on a bull spread or a bear spread. Okay, so if we're buying calls, for example, then what we would do is we would buy. And here I'm going to give you an example of one right here. Okay, here's Amgen. Okay, we got Amgen coming out of a demand zone here. Okay, and I have a target of about 100, right up here around the 160 level is my target. Okay, so I want to give this trade plenty of time to work. So I went out to the February calls, and I looked at the February calls, and at the 150, they were over $5. Okay, so in order to get my 3-to-1 reward to risk, I would have to be able to sell them for $20. Okay, well, if my target is 160, there's only a $10 difference there, so I'm not going to be able to sell those for $20. If I looked at the 150 160 calls, I don't remember the exact price that they were selling for, but it was between $2 and $3. Okay, so what I was able to do is I was able to buy the 150 calls that expire in February, and then at the same time I sold the 160 calls that expire on the same date. And I was able to do this for a total debit of $2.45. Okay, now I risked $500 per trade, so I was able to do 2 contracts. So I bought $250 calls and I sold $260 calls for a net debit of $2.45. If the stock goes up to 160 by expiration, then the puts are going to be worth, or I'm sorry, the calls are going to be worth $10, which is 4 times what I paid for the spread. Okay, now if it gets up there earlier, I may not be able to get that 3-to-1 reward to risk because there's still going to be some intrinsic value left in these calls, but there's other things that we can do that we'll get into in other videos to lock those profits in. But occasionally I'll put out a trade like that, and it'll say buy 150 calls, sell 160 calls, and if you're not comfortable with doing that, or you don't have the ability to do spreads in your account, then just pass on that trade. Don't take the trade. Don't just buy the option and take that higher risk, because that 3-to-1 reward to risk isn't in there. When you become a member of Zone Trades, and start studying these charts and studying these alerts, we'll also show you other ways that these can be traded. But as a general rule, we're looking for a minimum of 3-to-1 reward to risk, and your total investment is your risk. And this doesn't mean you have to trade them this way. Maybe you like trading stocks instead of options. Okay, well then make sure you watch the video on risk management. Your stop is going to be right below the bottom of a demand zone, and your stop's going to be right above the top of a supply zone. Adjust the position of your trade based on that stop. Your entry minus your stop is going to be your risk. You can also choose to go with in the money options. In the money options are going to get you more of a one-for-one move. Okay, but just remember that if the price gap's down against you, you may end up losing more than you intended to lose.